I think we do see a significant opportunity, in fact, in the markets at these levels. The U.S. has done very well. In fact, developed markets have outpaced emerging markets. Within Asia in particular, China has been a real standout market. We've seen a big rally, particularly in the tech area. So as the market has rebounded from the COVID lows back in January, we're actually right back at the levels where we were in around the 17th of January when we went into this crisis. China's come back, Taiwan's come back, largely driven by tech. That's what's done well. That sector has really led, along with healthcare. The whole work from home theme has worked, but there are some really big laggards, particularly in Southeast Asia. I point out the Singapore market as a standout, also Thailand, Indonesia, but also in Australia as well. So there's tremendous opportunity for those that are willing to dig beneath the surface and look for some interesting ideas in the markets that haven't participated fully in this recovery story.
So how are you digging below the surface and finding those opportunities? Are you more biased towards Asian stocks in this environment, given the value play, or do you see more momentum in the United States despite higher valuations?
So at Eastspring, we've gone overweight equities. We are in more of a risk-on mode. We think that the rally has legs. At first it was very much driven by tech. That has extended into other sectors, and we're seeing in the U.S. and Europe, in fact, that more deep cyclical areas of the market, very value-led parts of the market, are starting to recover a bit. So these are encouraging signs. So we still prefer equities over bonds. Within Asia, we're finding real value in Southeast Asia, in the real estate sector in particular. We think that in this low interest rate environment, there's a very good case to be made for yieldy REITs in particular, and also just property developers in the Singapore landscape. So that's been somewhat of a contrarian call. A lot of people assume no one will go into an office again, no one will go shop in a mall again, no one will eat in a restaurant. So all of this we think is priced in, and there's a tremendous opportunity.
News today of that Ant Financial mega IPO. Of course, Emily was telling us about that earlier. Is that something that interests you? It
is really interesting. I think, what's the big picture here is thinking about the talk around political risk and ADRs delisting from U.S. stock exchanges. I think Ant is a good example of the opportunity for the domestic market in China, whereby they're dual listing in 8 shares and the China Star Board. So investors domestically in China are probably very excited about, the opportunity to own such a good business. And, there are many more like that. So I think in the scope of things where there's a lot of sort of focus on geopolitical tensions between the U.S. and China and the upcoming elections in the U.S., this sends a very strong signal to the market in terms of the potential in the domestic China market.
You say you have a greater weight on equities versus bonds. For how much longer do you think you'll adopt that strategy?
I think, we tend to be long-term investors. We don't like to, go in and out of our conviction ideas. The equity markets that, the easy money's been made. There's no doubt about that. We have had a very strong V-shaped recovery. If you look at like a global index, like the MSCI ACWI index, for example. But within that, the U.S. has done very well, no doubt. But we're no longer seeing the U.S. as having all the growth. There's growth outside, and the world is adapting to COVID. We know what we're up against now. Economies are starting to reopen, and we're getting closer to a vaccine. So we think that equities in this environment should continue to do well, and that the trends that were happening before COVID, which were very strong growth trends, will reassert themselves once things normalize.